There is a brand new tax rule on the books that honestly could put the homes of millions of seniors at serious financial risk. And it seems like almost nobody is talking about it yet. So if you're 65 or older and you own your home, you're going to want to listen very, very closely. What we're about to cover could literally determine whether you keep hundreds of thousands of dollars or lose it to the IRS. This is really critical stuff. So let's get to it. So here's the big question everyone should be asking. Your home is probably worth more today than at any point in your life. After decades of mortgage payments and property appreciation, you're sitting on what might be your single largest financial asset. But here's the problem. That wealth is locked inside your house, and getting access to it, or even just staying in that house, comes with a complicated web of tax rules that can either work in your favor or completely blindside you. And this is the number that should really make you sit up and pay attention. $500,000. That's how much profit a married couple can potentially exclude from taxes when selling their home. Completely tax-free. But here's what concerns me. Most people have no idea about the specific rules they have to follow to actually get that benefit. Miss one requirement, and you could end up owing tens of thousands in taxes you never expected to pay. And that's real money that should have stayed right there in your pocket. Let me tell you about a couple we'll call Richard and Barbara. Both in their early 70s, married for over 40 years, owned their home for 3 decades. They decided to downsize and move closer to their grandchildren. Their home had appreciated significantly, and they were looking at a profit of around $420,000. They assumed it would all be tax-free. They'd heard something about a home sale exclusion years ago. What they didn't know was that Barbara had been living in a care facility for the past 3 years due to health issues. Richard had been maintaining the house, visiting Barbara regularly, but technically, Barbara hadn't used the home as her primary residence for the required period. I'm going to come back to what happened to Richard and Barbara in just a bit, because their story illustrates exactly why understanding these rules matters so much. What they discovered almost cost them a fortune. Okay, so let's break down everything you need to know. We're going to cover 4 major areas today that every homeowner needs to understand. First, we'll look at the cornerstone rule for selling your home completely tax-free and the specific tests you absolutely have to pass. Then we'll get into the tax breaks available if you want to stay in your home and age in place. After that, we're going to clear up all the confusion around reverse mortgages and how the IRS actually treats that money. And finally, we'll look at some deductions that could shield even more of your retirement income. So let's get into it. This first section is absolutely foundational for any homeowner thinking about selling. It's called the Section 121 exclusion, and honestly, it's one of the most generous tax breaks in the entire tax code. But it comes with rules that you cannot afford to ignore. Getting this wrong is how people lose serious money. Here's the core benefit. If you're single, you can sell your primary home and exclude up to $250,000 in profit from your taxable income. And I want to be clear about what exclusion means. It's not a deduction. It's better than that. The IRS treats that money like it never existed. It just vanishes from your tax bill completely. And if you're married filing jointly, that exclusion doubles to $500,000. For anyone who bought their home decades ago and watched values climb year after year, this is potentially the biggest tax break you'll ever receive in your entire life. But here's where people get tripped up. To qualify for this exclusion, you have to pass 2 separate tests, and both have to be met in the 5 years leading up to your sale. Miss either one, and you could lose part or all of that exclusion. The first is called the ownership test. Pretty straightforward. You have to have owned the home for at least 2 of the 5 years before you sell it. The second is the use test. This one catches more people than you'd think. You have to have actually lived in that home as your primary residence for at least 2 of those 5 years. Not a vacation home, not a rental property. Your actual primary residence where you sleep most nights. Now here's a detail that matters a lot for married couples. Only one spouse needs to meet the ownership test. Both spouses have to meet the use test to get that full $500,000 exclusion. And this is exactly where Richard and Barbara ran into trouble. Richard met both tests easily, but Barbara only met the ownership test because she'd been in a care facility for the past 3 years. Their exclusion was going to be significantly smaller than they expected. They were looking at potentially paying taxes on a huge portion of that profit. But wait, here's something that most people don't realize, and this is the part that could save you a fortune. The tax code actually has built-in exceptions for major life events, and one of them applied directly to Barbara's situation. For seniors who move into a licensed care facility, the rules are more flexible. Instead of needing to live in the home for 2 of the past 5 years, you only need 1 year of residency. Barbara had lived in the home for over a year before moving to the care facility, so she actually qualified under this exception. Once they understood this rule, they were able to claim the full exclusion, but they almost missed it because nobody had explained these exceptions to them. There are other exceptions too that you need to know about. A surviving spouse gets a special 2-year window after their partner passes away to sell the home and still claim the full $500,000 exclusion. If you have to move for health reasons before hitting that 2-year mark, you can often get a partial prorated exclusion. These aren't obscure loopholes. They're legitimate provisions designed to help people in difficult situations, but you have to know they exist to use them. Type "didn't know this" in the comments if any of this is new information for you. I'm genuinely curious how many people are learning about these rules for the first time. All right, let's move to the second major area. What if you don't want to sell? What if you want to stay in your home as long as possible? For a lot of people, that's the dream. Well, the tax code actually gives you incentives to make your home safer for aging in place, and it all connects to medical expense deductions. Here's how this works. If you itemize deductions on your tax return, you can deduct qualifying medical expenses. But there's a threshold you have to clear first. You can only deduct the portion of your medical expenses that exceeds 7.5% of your adjusted gross income. Think of adjusted gross income as your total income after certain deductions. So if your adjusted gross income is $60,000, you need more than $4,500 in medical expenses before you can start deducting anything. Now, here's where it gets really interesting for homeowners. When you make modifications to your home, primarily for medical reasons, those costs can count as deductible medical expenses. And for certain types of modifications, you can deduct the entire cost. Things like wheelchair ramps, grab bars in bathrooms, wider doorways, railings, and similar accessibility features. The IRS takes the position that these modifications don't really add to your home's resale value. They're purely medical necessities. So as long as you're above that 7.5% threshold, you can deduct every dollar you spend on these improvements. But what about bigger projects? Things like installing an elevator or building a therapeutic pool. These do add value to your home, so the calculation works differently. The IRS uses a simple formula. You take what you paid for the improvement, subtract how much it increased your home's value, and the difference is your deductible medical expense. Let me give you a real example. Say you install a home elevator for $25,000. An appraiser determines it added $15,000 to your home's value. Your deductible medical expense is $10,000, the difference between what you paid and the value it added. Still a meaningful deduction, just not the full amount. This matters because these modifications can be expensive, and every deduction helps stretch your retirement savings further. But you need to keep good records. Document the medical necessity. Get a letter from your doctor if possible. Keep all receipts. If you're making a major improvement, consider getting an appraisal before and after, so you can properly calculate the deductible portion. If this information is helping you understand how to protect your home and your finances, hit subscribe. We cover retirement rules and tax strategies that most people never hear about until it's too late. Okay, now let's tackle the third area. And this one has more confusion and misinformation swirling around it than almost any other topic. Reverse mortgages. Specifically, how does the IRS treat the money you receive from a reverse mortgage? I hear wrong information about this all the time, so let's clear it up once and for all. For anyone unfamiliar, a reverse mortgage lets homeowners who are 62 or older convert some of their home equity into cash. You can receive it as a lump sum, monthly payments, or a line of credit. You don't make monthly payments like a regular mortgage. The loan gets repaid when you sell the house, move out permanently, or pass away. So here's the million-dollar question. When you receive that cash, does the IRS consider it income? Are you going to owe taxes on it at the end of the year? And the answer, thankfully, is no. The IRS classifies reverse mortgage proceeds as a loan advance, not income. This is a really important distinction. Because it's a loan, not income, that money doesn't show up on your tax return. It won't push you into a higher tax bracket. And critically, it generally won't affect your Social Security benefits or Medicare eligibility either. Let me be very clear about this, because I've seen people get confused. The cash you receive from a reverse mortgage is not taxable income, period. Whether you take it as a lump sum or monthly payments, the IRS treats it the same way they'd treat any other loan proceeds. That's the good news. But here's where things get a little more complicated. With a regular mortgage, you pay interest every month, and you can typically deduct that interest on your taxes each year. A reverse mortgage works differently. The interest accumulates over time and gets added to your loan balance. You don't actually pay it until the loan ends, which is usually when the house is sold. So, can you ever deduct that interest? Yes, but only under very specific conditions. First, you can only deduct the interest after it's actually been paid. Since reverse mortgage interest usually gets paid all at once when the loan is settled, that's when the deduction becomes available. You can't deduct it year by year as it accumulates. Second, and this is the part that surprises most people, the interest is only deductible if you use the reverse mortgage proceeds for very specific purposes: buying, building, or substantially improving your home. If you use the money for living expenses, medical bills, travel, or anything else, that interest is not tax deductible. Not a penny of it. This doesn't make reverse mortgages a bad option. The tax-free nature of the proceeds is still a major benefit. But you should go in with realistic expectations about the interest deduction. For most people using reverse mortgages to supplement retirement income, that interest won't be deductible. Now let's get to our fourth and final area, and this one ties everything together. We need to talk about how deductions for seniors can work alongside these home-related strategies to protect even more of your retirement income. Here's how this works. Once you turn 65, you automatically qualify for an additional standard deduction on top of the regular amount everyone gets. For a single filer 65 or older, your standard deduction is already significantly higher than what younger taxpayers receive. For married couples, where both spouses are over 65, you each get that extra amount added on. But here's what makes this powerful when combined with the home strategies we've discussed. Every dollar that gets excluded or deducted is a dollar you don't pay federal income tax on. And when you stack these benefits together, the numbers get significant fast. Let me walk through an example. Say you're a married couple, both over 65, with retirement income of around $50,000 annually. Between your standard deduction and the additional amounts for being over 65, you might already have close to $32,000 in deductions. If you also made qualifying medical modifications to your home, those deductions stack on top. If you sold a previous home and excluded the profit under Section 121, that money never hits your taxable income at all. The point is, these aren't isolated rules that exist in a vacuum. They're tools that work together. And when you understand how they interact, you can make much smarter decisions about your home and your money. Now, let me finish Richard and Barbara's story. After learning about the care facility exception, they were able to claim the full $500,000 exclusion on their home sale. That $420,000 in profit stayed completely tax-free. They used part of it to buy a smaller home near their grandchildren, put the rest into their retirement savings, and their Social Security benefits weren't affected at all. But here's what struck me about their situation. They almost made a very costly mistake simply because they didn't know the rules existed. They were one confusing conversation away from accepting a much smaller exclusion and paying tens of thousands in taxes they didn't actually owe. Now contrast that with another couple I'll call James and Patricia. Similar situation, similar home value, but they did their homework well before selling. They knew about the 2-year use test. They knew about the care facility exception. They even timed their sale strategically to maximize their exclusion. Same rules available to everyone. Completely different outcomes, all because of preparation and knowledge. So let's bring this all together with what you should actually do right now. First, if you're thinking about selling your home in the next few years, verify that you meet both the ownership and use tests. Count backward from your expected sale date and make sure you have at least 2 years of ownership and 2 years of primary residence within that 5-year window. If there are any gaps or complications, look into whether an exception might apply to your situation. Second, if you're planning to age in place and need to make modifications, document everything from the start. Get written recommendations from your doctor. Keep detailed records of what you spend and why. Consider consulting with a tax professional about what qualifies as a deductible medical expense in your specific situation. Third, if you're considering a reverse mortgage, understand exactly how the IRS treats the proceeds. Remember, not taxable income, but the interest situation is more complicated. Make sure you're making decisions based on accurate information, not myths or rumors. Fourth, keep track of how all these benefits interact with your overall tax situation. The standard deduction, the senior additions, medical expenses, home sale exclusions, they all work together to determine what you actually owe. And here's a final warning I have to give you. Anytime there are tax benefits this significant, there will be people trying to take advantage of confused seniors. Be extremely careful about anyone charging money to help you claim deductions you can claim yourself. Be suspicious of anyone promising results that sound too good to be true. The IRS provides free resources. Tax software handles most calculations automatically. Don't pay someone for something you can do on your own or with the help of a legitimate tax professional. If this helped you understand how to protect your home and your retirement, hit subscribe so you don't miss future updates. We cover rules and strategies that affect your money, the kind of information that usually doesn't get explained clearly anywhere else. Drop a comment below and let me know. Did you already know about these rules, or is some of this new information? Have you used the Section 121 exclusion, made medical modifications to your home? I read every comment, and your experiences help shape what topics we cover next. Share this with anyone you know who owns a home and is approaching retirement or already there. These rules can protect hundreds of thousands of dollars, but only if people actually know about them. Thanks for watching. Your home is likely your biggest asset. Make sure you're protecting it with the right knowledge. Stay informed, stay prepared, and take care of your finances.